All right, let me welcome in Vinit Sambre. He's joining us as well on the show this morning. Vinit, good to have you with us. We're seeing an uptick today, which is heartening. Yesterday was incredibly volatile, and we're really just taking it day by day at the moment. What's your sense, Vinit? Do you feel we've somewhat at least bottomed in terms of the fear? Or do you feel it's still early days? Perhaps markets are still awaiting commentary coming in on the back of stimulus hopes and so on.
Yeah, good morning, and thank you for having me here on the show. So I think clearly we have seen one bounce after hitting a low some times back. And as you said, I think there is some amount of optimism building in as government keeps talking about lifting of these lockdowns. It's a phased lifting of lockdown. People are hoping that things should start coming back to normalcy. But my sense is that it's slightly a bit too early to judge and make an assessment on these issues, which actually are very uncertain. You don't actually have any past history of these type of issues where you can actually draw analogies, and so hence I believe that while things have been announced by the government, but till the time we do not see the normalcy returning back, there could be a certain amount of volatility. This uncertainty may also cause a lot of confusion while we come back, and also who knows the new normal when we come back, how much can we compare it to the old normal, because the new way of thinking, new way of living standards may be totally different from what we saw in the past, given the magnitude of the problem we saw in this last 1 month.
So, Vinit, what happens if there's an extension of a lockdown? I mean, we're so far seeing companies, stay away from, like in terms of also brokerages coming out with targets on earnings and so on and so forth. Everyone's holding off till we get a better sense of the situation, how it's evolving, how long this lockdown may extend as well. Do you feel we might see a further route of selling if we do see an extension and, in fact, weaker outlook on the back of that?
Clearly, I think the more we extend, the more damage we are going to cause to the economy, and that's not going to be taken positively by the market participants either. We are also trying to assess this situation, and the more we are putting our thoughts around our interaction with the company, suggest that in everyone's mind, the bigger solution right now is the quicker we come out of this mess, I think the companies will be okay to do. But the longer we actually stay put, if this problem were to last longer, I think we are going to definitely see worsening of the problem. There will be insolvencies, bankruptcies, which may come up. The small and unorganized sector has seen a very big amount of pressure right now. So I think the more we delay in terms of coming out of this problem, if this pandemic were to spread and not get contained, and we have to extend this opening up of the lockdown, then I think we are going to see further worsening of the environment, and will have a similar impact on the stock prices as well.
Vinit, wanted to get in your take as to how you're looking at the capital goods sector as well. And, the expectation is that the COVID lockdown will, of course, suppress the performance for most of these companies. There was a challenge as well of, the supply constraints from China. Project execution as well will have come to a halt. A lot of these companies stand to be impacted directly. What is the outlook when it comes to earnings and how you're placing your bets on the capital goods sector?
Clearly, I think in the immediate terms, across the sector, we are going to see impact of this shutdown and lockdown. And to some extent, some businesses will be impacted more, some businesses will be impacted less. I think the businesses which are, in certain form or fashion related to usage of a lot of the labor, and today we are going to face those issues. Businesses which are going to be linked to transportation, businesses which are going to be linked to travel and tourism. So I think many sectors are going to face these problems. And in sync with that, I think capital goods, due to the logistics, being an issue right now, I think the near term is looking challenging. But across the board, what we are trying to do as a fund house is trying to focus on companies and businesses which generally have the strength to withstand these pressure points, companies which have the strength to last long in this crisis. And we believe companies with lighter balance sheet, with low debt, with generally the nature of generating higher cash, I think those type of companies will survive. So I think first and foremost, the focus is on companies which will survive and to hold them in the portfolio. In sync with that, I think capital goods is a sector where selectively we have been looking at few companies where we have good visibility on their balance sheets. But as I said, the near term will look very challenging till time we normalize, we see normalization of the situation taking place.
Okay, just want to mark the markets right now, and on the Nifty 100 as well, there's only a handful of stocks that are in the red. Other than that, you are seeing strength coming in across quarters. You've got Cipla, which is up a solid 15% today. Take a look at Lupin, 750 plus on that candidate. You've got Vedanta firmly in the green, Cadila, Sun Pharma. So of course, you are continuing to see that fervor within the pharma pocket. But then there's DMart or Avenue Supermarts, which is active in today's trading session. Wipro, Godrej Consumer, Tech Mahindra and HDFC too are up about 3.5%. Infratel, Aurobindo and IndusInd Bank are some of the other candidates that are managing to hold out quite well. Vinit, what's the take when it comes to the OMCs, owing to the kind of pressure that we could see at the end of the quarter due to the lockdown impact and, the beaten down refinery earnings as well from the steep inventory losses. All of that is likely to affect the overall earnings picture. What's your stance?
Actually, I think OMCs today, while they are going to see the impact of this lockdown, but one point in their favor is the valuations. Today, most of the OMCs have seen massive correction, and most of the negatives have in a way got built into the price point. So I think from the price point perspective, the valuations for the OMCs are really looking reasonable, if I can use that word. And in terms of the volatility, there is one impact of the lockdowns, but the other real impact is also going to be the crude volatility. We've seen crude fall significantly from the highs. That generally is positive for OMCs in the short term. But any measures which US or other economies take to bump up the crude price can again cause that amount of volatility. So in that context, there could be a certain amount of impact due to the inventory losses or inventory gains as we move ahead. But by and large, most of the OMCs today, whenever the normalcy resumes, must be booking higher amount of marketing margins. That's positive for them. And the valuations is in their favor right now.
Sure. Just looking at how some of the pharma names are charging ahead. Look at Cipla. It's holding up 15% higher right now. Lupin is sitting at gains of about 7.5%. You've also got the likes of Cadila, which was a big mover yesterday as well. That's pushing forward another 2% as we speak right now. Vinit, the street seems to have just rediscovered its love for pharma, which was most beaten down and most ignored for the last year and a half. And now, because of the exports of generics chloroquine to the US, a lot of avenues now opening up with healthcare as well. Pharma seems to be the new discovered gold mine that the street has discovered. Where within pharmaceuticals do you find comfort? Are you buying afresh into any of the pharma names?
Fortunately, as a house, we have been owning quite a bit of these pharmaceutical names in our portfolios for the last 3 to 4 years. And the overall assessment for us was the pharma sector was being ignored. The valuations were generally relatively much better placed. And if we by and large compare the growth, it tracks the growth trends in sync with what the FMCG does. But the valuations were pretty low given the problems these companies faced from the US FDA and the generic pricing issues. Now, on the other hand, I think suddenly, like you said, there is a lot of euphoria as if all the pharma companies, they have discovered the drug for COVID problem, and that's what is sort of now getting built into the price point. To some extent, there is a certain amount of excess also in certain amount of stocks, which is also seen right now. It is more to do with the general euphoria and also the fact that pharma will be relatively more defensive in this turmoil because of their ability to keep selling the drugs because these are essential in nature. So we still continue to hold a positive view on the pharmaceutical businesses because we see them as more linear in nature. But we also get worried when suddenly we see price reactions taking place in a very short duration. Those are the time probably we will sort of just hang on with our the holdings what we have. But over a longer term, we'll keep evaluating good businesses and good companies within the pharma index.
Sure. Vinit, it seems like a steady recovery is in place. At least, the FIIs are turning back to the markets. Who knows? Never say never, but it seems that the worst is at least temporarily behind us. In this time, do you also go back to the drawing board and pick out what should one not invest in? Are there sectors that you're categorically avoiding and selling out of at this juncture as well?
Yeah, so as I said, clearly, what we are trying to identify is, this is a problem of a very large magnitude and not seen by anyone ever. I mean, the world getting shut is something which is unheard of, and I don't think anyone, including the managements of companies, are aware as to how things are going to unfold in future. So our sense is that but still, I think the companies are looking at the survival strategies right now. And in sync with their thought process, our core principle is to be with companies which will survive these turbulent times. And we believe companies where they have, as I mentioned, less amount of leverage in the balance sheet, they are generally by nature positive cash flow businesses, capital efficient companies. I think the focus is that. And we are looking to sort of move out of businesses or companies which are leveraged as such because if the pain were to get prolonged for a long period, I think it will be difficult for such companies to survive, and hence trying to not sort of prefer companies with higher leverage, trying to move out of businesses which are weaker or inferior strategies or run by inferior management. So I think by and large across the board, we are trying to look at exiting some of those companies. And in terms of segments, I think clearly what we have sort of avoided as such by and large has been largely the utilities, the PSU pack as such overall. We have also sort of been underweight in some of the other segments which are more capex oriented, like the metals and other sectors of similar nature. So I think in principle, also the FMCG, because of the excessive valuations, we have underweight positioning right now. Despite the fact that relatively on a relative context, they would be better off in terms of their business metrics. But that's what our thought process goes.
Okay, let's talk about banks, Vinit. That's one pocket we haven't touched upon, and it's a big chunk of what you're looking at right now. What are you making of valuations for the private names? Any risk you see to what we might see in terms of defaults down the line, how this would impact some of these major banks, or are they well capitalized and ready for that? What's your sense? And, would you perhaps be looking at even perhaps adding more to your portfolio at this point?
Yes, I think banking is the most important segment, and it is almost a proxy to the economic environment. We clearly feel that banking actually has to go through some sort of an acid test in the coming months, because of a simple fact that if there are, let's say, some bankruptcies or insolvencies getting announced immediately, it can have a big bearing on the net worth or their book value, and which is what we saw in a few cases in the last couple of months, where even within the private sector, some of the well-run banks have to face a lot of pressures because of the asset quality problem. So I think we will have to tread very cautiously in the segment, while we still continue to hold a positive view, given the fact that we believe that as the economic recovery starts taking place, some of the banks which they have survival instincts within the private sector, those will come back up and will have higher market share. So I think today, in the current environment, the banks which we are sort of looking at, and we find a huge amount of value there because of the massive correction they have seen, I think are the ones where they face less of liquidity challenge. They have had a very or impeccable track record of very good asset quality in the past. And also they have more granular book to showcase, and in terms of their distribution, in terms of their reach, I think they are much better in terms of those aspects. So I think what we are trying to do is try to anyways we are equal to overweight in the banking sector, but trying to be with these type of institutions where we believe they will survive this crisis, and eventually when we see the recovery, which who knows, maybe a matter of 2 months, 3 months, 6 months, or 1 year, the patience will get tested. But I think some of these banks will not only survive but eventually thrive in the new regime.
All right, Vinit, we'll leave it there. Thanks so much for joining us today and taking us through your view on things as they stand.